Hey everyone, so welcome to episode 16 of Journaling My Trading Process. Now, today I want to talk about something serious. So, I was listening to a couple of videos on, on trading, and then I began to learn a couple of things also. So, um, so I realized that in order for someone to become profitable, there is a set of way that the person has to know. There is a set of thinking, set of habits. Now, what do I mean by that? If you look at, let's use poverty and wealth for example. If you look at those who are poor and those who are wealthy, you will notice that you can see a similar thought pattern of poverty, those who are poor, and you can see a similar thought process of wealth in those who are wealthy. So and that's I think that also applies to trading. So I think that also applies to trading. So I think that also applies to trading. When you see traders who are profitable and those who are not profitable, there is a there is a set of pattern. There is a way they think. There is a way they think, and some of them might not even be aware of it. Might not even be aware of it. So number one, those sets of habits. Number one, those who are profitable, they prioritize higher time frame. They really prioritize higher time frame. They don't joke with that a lot, and it doesn't even matter the strategy. You see, because I've seen profitable traders trading support and resistance, profitable traders trading ICT, some trading Falcon, and each and every single one of them, they really prioritize higher time frame. They really preach this a lot, they really talk about it a lot. Higher time frame, knowing what the higher time frame is doing. They might be using different language, but all of them are saying the same thing. They really prioritize higher time frame. Then the second thing also is that they stick to realistic RR, that's risk to reward in their trades. Now, what do I mean by this? When they are in a trade, they are not when they are in a trade, they are not trying to catch the whole, they're not trying to catch 1 to 30, 1 to 40, 1 to 50. They really stick to realistic RRs, and you may even see many of them sticking to just 1 to 3, some even 1 to 2, some 1 to 4, maybe 1 to 5. So a lot of them, this cuts across different strategies. Like I'm not if I'm just talking about okay ICT, then they will say I'm being biased. But I've seen this in traders who trade different strategies. They really stick to realistic RRs. They are not chasing, they're not trying to catch 1 to 10R. They know that in this trade the safer zone is to leave it at a 1 to 3, and they leave it like that. They're not chasing profit and like that. So the third thing I noticed about them is that they stick to risk management. They literally, in fact, capital preservation for them is number one priority. Capital preservation is their number one priority. It doesn't matter what this pressure to want to make money quickly. Capital preservation. So they have a percentage of how much they are risking. They are not making the decision when they want to trade. There's already a structure of how much they are meant to risk per trade. They really, so capital preservation, they stick to to risk management. Fourth thing I noticed about successful traders is that they take lesser trades. Now, this one is really a banger. What do I mean by that? This one, I've seen it a lot, I've noticed it a lot. They take lesser trades. In fact, this is among the topmost quality. Like when you meet a successful trader, this quality is one of the ones that you can easily notice at an instant. They take lesser trades. They are not always trading. They are not always trading. They take lesser trades. They are not always on the chart hunting setups, looking for setups, and that way they eliminate a lot of losses that they would. The more you are trading, the more you are exposing your account to risk. So these guys, they really understand this thing. They take lesser trades seriously. And then the fifth thing I noticed about the fifth thing I observe about social traders is that they they take records. Like they do track records. Some call it journaling. And this cuts across different varieties of traders trading different varieties of strategies. Is that some call it journaling. So they track their progress, and you can do this in so many ways. You can do this in so many ways. You can do this in so many ways. So there are so many different ways that different traders actually fulfill this principle. So they track their progress a lot. Some call it ASR, that's advanced self-review. Some is journaling. Some is journaling um their day to day, like after a trade. So they journal emotions and all those things. So they and it only makes sense because even when you look at a business, there's always a book of records. Imagine if how then do they know the profit they made, or if they made a loss, or that. So it only makes sense that you can only grow when you know where you started, you know where you're going, you know where you are at. So there can only be progress when you know if you're actually making progress. So they don't just take trades randomly. Everything is calculated. They don't enter into trades impulsively. They don't just open a chart. No prior analysis, no breakdown, nothing. You don't understand where the market is going to, and then you just take trades. No, they don't do that. So I'm still doing my research, I'm still doing my findings, and promise when I have more, I'm still going to come back and share to you guys so we can grow, we can learn, and we can grow together. So thank you for staying, and see you next time on our next episode.